welcome back to the Investing Markets and Money podcast and vidcast. And this week we're talking markets. We've got Michael Brown from Pepperstone joining us on the show, really for a wide-ranging discussion about what's going on in financial markets. Welcome to the podcast, Michael.
Well, thank you, Stuart. Very good morning to you, mate. And thanks for having me. Looking forward to our conversation.
Yeah, no, first time for you on the podcast, and great to have someone who's got a wide-ranging base of knowledge about what's going on at the moment. And certainly there is quite a bit going on.
Well, yeah, I think that might be an understatement. I'm going to have to put a check in the post now for that compliment, aren't I? But yeah, there's certainly a hell of a lot going on in financial markets. We had arguably quite a dull summer, and then kind of since mid-September onwards, things have just gone a little bit berserk once more, which I guess when you're sat here as a sell-side strategist, I probably shouldn't complain too much because it gives us plenty of material to get our teeth into, and ultimately that's what we like. So.
Well, one of the big trades of the year, and one that I'm personally still in, is obviously the gold trade. But we've also seen, gold keeps hitting new highs, but we've also seen silver suddenly take off as well, which a lot of the precious metals analysts we speak to have been predicting that silver was going to take off, and now it's on its way. What's your feeling on the precious metals market from Pepperstone?
Yeah, well, I mean, the run that we've had this year in both gold and silver has been remarkable. I mean, what are we up 50-odd% year to date in gold, 70-odd% year to date in silver? I mean, that's frankly remarkable. But actually, it makes a lot of sense. When you think about everything that's going on in the world, and you think about the bull case for precious metals, you're kind of going, well, inflation is moving in the wrong direction, and inflation expectations are moving higher, so people want to hedge that risk. You've got governments, certainly across developed markets, and I know we're going to talk about the UK in a short while, where government spending is just on this runaway and unsustainable trajectory that nobody seems to want to be doing anything about. You've got a lot of risk in general, whether that be in terms of trade, whether that be in terms of geopolitical or conflict, all that kind of stuff. And then you've got this ridiculously high level of physical demand, not necessarily in terms of speculation, but people actually wanting to buy gold in physical form, whether that be bars or bullion or whatever it may be. And that's coming from both the retail space, you and I, but also in terms of reserve asset allocators who are very much in emerging markets looking at their reserves and saying, do I want to be holding everything in US dollars, or do I want to diversify into hard assets like gold and like silver? And really, that has been the case for 3.5 years now, since Russia's FX reserves were seized at the beginning of their war with Ukraine. That's really been a trend that shows no sign of slowing down. So you've got almost a sort of perfect storm for gold, where you've got a kind of price insensitive buyer in the market in these emerging market central banks, massive demand from that fundamental bull case that we just mentioned, and then momentum has just been a one-way train all year. And you kind of throw them all together and you go, well, it's obvious that we've come so far so fast. I mean, we have come off a little bit in recent days, and obviously gold is down at the time of recording this, silver back under $50 an ounce. But I think it's far too early to call an end to this run.
Yes, it's a run that people have been calling an end to for a while, but it's the gift that keeps on giving.
Well, absolutely. And this is one thing that, has been going on all year, whether it be precious metals, whether it be equities, whatever it may be. People love to try and call a top in the market, and very, very seldom do people get that right. And yeah, maybe we've come too far too fast. We've done 10% or so in the last week when you look at gold, but that bull case is still a very, very solid one. So actually the way I would be looking at it is, if we do get some downside of the like that we're seeing now, it's actually just taking a little bit of froth out of the market, flushing out some of these sort of weaker longs, and actually that results in a sort of more durable bull case as we move forwards, because positioning is much, much lighter and people can come and add back in. So yeah, I'm still viewing gold and silver actually as a buy on dips right now.
And I mean, one of the factors behind it is, in my personal opinion, is that there's more of a crisis of confidence in the US dollar at the moment, and part of that being driven by debt issues. Last week we saw a lot of I don't know, I wouldn't call it scaremongering. There was a lot of negative sentiment around the US banking sector, US regional banks. It seemed to be a bit of a spillover from issues with car financing. That now seems to have gone quiet as of this week, at time of recording. Do you think that that's going to be coming back? Do you think that was just a flash in the pan? Someone just panicked. People started talking about the next Lehman Brothers. Or was there something?
Yeah, well, whenever that starts getting thrown around, you know that the hyperbole is starting to run away with itself. I must admit, I did chuckle a little bit last week because, as you said, we had these issues with US regional banks. On Tuesday afternoon, if you asked any market participant, they'd never have heard of Zions Bancorp or Western Alliance. And by Thursday afternoon, apparently these two were the next sort of systemic risk. This may well be famous last words, and you are welcome to clip it up in the future and come back to me in 6 months' time. But I don't think that this is sort of anything bigger than these relatively isolated and sort of idiosyncratic incidents that just happen to all occur at a relatively similar time. These regional banks were taking very, very small, in the grand scheme of things, write-downs on some loans that they'd written that were actually subject to fraud. You had the First Brands and the Tricolor incidents in terms of those bankruptcies, but they seem relatively contained. I think the problem and the reason why markets became so jittery is because you had, 3 or 4 bits of news that sounded quite similar happening at the same time. You then had everyone going, oh, well, hang on a minute. We had this in 2023 with Silicon Valley Bank. Is this a rerun of that scenario? To be clear, I don't think it is. And then at the same time as that, you had quite incredible tightness in terms of money markets in the United States, effectively a bit of a shortage of cash or a squeeze in terms of financing conditions. But again, that owed to idiosyncratic factors like a tax payment deadline, and there were some treasury auction settlements in the mix as well. So I think it was a sort of classic case of participants just over extrapolating from what were relatively small incidents and blowing things, sort of making a mountain out of a molehill, for want of a better word. But what I would say is, when you have an equity market that is kind of priced for perfection, as we have been all year, any negative news is going to have an outsized impact on the price action, which is exactly what we saw, towards the middle of last week.
And staying on the subject of debt, obviously US government debt keeps trending higher. Again, we're seeing a lot of fears. I'm getting a lot of stuff being sent through to me at the moment by analysts and wealth managers, hand-wringing going on about how much further can this go? How much longer can the US keep borrowing and printing dollars? Is this just an infinite trend that continues to underpin the Western financial system?
Well, in short, yes, it is. We could have sat here probably 10 years ago, maybe 20 years ago, and had the same conversation. The fiscal trajectory of the US and pretty much everywhere in developed markets in the G7 is unsustainable. I think we all know that, we all acknowledge it, but no one really wants to seems to want to actually tackle it, because it means taking very, very difficult and politically unpalatable choices that, frankly, no politician is ever going to make. I think the market is becoming a lot more sensitive to the issue. Certainly on this side of the Atlantic, the US has a sort of exorbitant privilege in terms of being able to issue treasuries, because obviously the dollar is a global reserve currency. But obviously we know the well-documented issues here in the UK. We've had a couple of failed or technically failed German auctions recently. France has had a couple of credit ratings downgrades, and another one's probably coming on Friday from Moody's. So I think it is getting to the point where market participants have no choice but to sit up and take notice of what's going on. And I think the big issue for me is not necessarily what's happening now. If you look at the United States in particular, the budget deficit is running at about 7% of GDP. The problem for me is what happens. Well, I'm going to say when, because there will be some sort of recession or slowdown or crisis at some point in the future. We just don't know when. But when that does happen, where does the stimulus come from? Because normally you're running a 7% debt GDP ratio in the middle of a recession. Right now, we're going into a recession at that level of fiscal spending. You're probably going to push the deficit out to, say, 10% when you end up needing to provide that stimulus in the event of a future slowdown. So actually, this is a problem that will only get worse. I mean, I think The last thing I would just say on this is I don't have a worry that the market will not be able to absorb the supply that's coming down the track. I think we all know that bond issuance is rising wherever you look in developed markets, and that's coming at the same time as central banks are continuing to pull back from the market. There will always be demand for developed market bonds. That's pretty much always going to be the case. The question is, what yield, what premium do investors demand in order to hold those bonds? And that's a problem that the UK is discovering right now, whereby we're having to pay a significant premium over our peers in order to issue debt, in order to get the market to finance what the country wants to finance. And I think that's going to be an increasing issue as time goes on. The difficulty with all of this is there's not really a trade in it, to be completely honest with you. This is something that is a theme that will pan out over years, if not decades. You can't position, for example, short end of developed market curves, short the long end, just based on this. It's simply, not a sustainable position to be in. But at some point, the bond vigilantes will be back. I have no doubt about that.
And tariffs and the tariff war with China specifically, that was another thing dominating headlines. Again, markets seem to be responding to that. There is this sort of knee-jerk reaction every time Donald Trump stands up and uses the T word. And consequently, we end up with sudden market reactions, volatility comes in, and then it all goes away again. This seems to me being driven slightly more by China, and the US is now reacting to restrictions on things like rare earth metals exports. What's your take on this? Do you think this is just another flash in the pan and it's going to go away again?
Yeah, I think that's probably a good summation. And actually, I would agree. I think China was sort of proverbially poking the bear and got a response out of the bear eventually. We not only had the rare earth controls, we had various probes into companies like Nvidia and Qualcomm. There was also some issues going on with shipping and port fees. So, there were a number of factors. Frankly, I think, ultimately we're just going to have to get used to this. The US and China have had a fractious relationship for a very long period of time. And we know that the Trump administration want to engineer this sort of slow and steady decoupling from China over the next number of years. There are going to be points in the next sort of 3.5 years, if that's the remainder of Trump's term, there are going to be points where things are looking all fine and dandy, as we had sort of earlier in the year, just after that trade truce was first agreed in Geneva. There are going to be points where tensions are much, much higher, of the like that we saw last week. And that situation is not helped by the way in which President Trump negotiates, which is basically a sort of escalate to de-escalate strategy, where you throw a ridiculous threat on the table in an attempt to try and focus some minds, and then use that as a way of extracting concessions from the other party that you're negotiating with. And interestingly, this isn't new. This is something that he's been using for 40 odd years. It's actually written in Art of the Deal, which was published, in the 80s or 90s. So, this is not a sort of novel strategy for President Trump. The problem when you apply this to financial markets is, and this is why we had such a violent reaction to the threat of an additional 100% tariff, every market participant who has been following this closely since Trump was inaugurated back in January knows that this probably isn't going to happen. They know that this is a negotiating ploy. They know it's a tactic. They know it's a threat. But at the same time, every market participant has to hedge the possibility, even if it's so slim you can barely see it, that these tariffs do go into effect, because nobody can be sat there on the 1st of November. Imagine these tariffs do go into effect and get a tap on the shoulder and go, well, hang on a minute, the leader of the free world literally said he was going to do it and you thought he was bluffing. How on earth do you justify that to a risk manager or whoever's given you an investment mandate or whatever it may be? So that's why we keep getting these really violent reactions, because we have to take the initial threat seriously, even if we don't think it's actually ever going to happen. But fundamentally, there's all this talk of a deal with China. There was a deal with China in 2019, and they never stuck to it, and we all just kind of forgot about it. So that would be sort of the base case. If and when the two sides strike another deal, it's then a question of compliance. It's a question of which sectors does it apply to. But each side has something the other one wants. China wants chips from the US. The US wants rare earths from China. It's in both sides' interests to get this settled and ensure that there is not a significant shock to the global economy. It's just going to be a very bumpy road until it is settled, I think.
And the S&P 500 continues to do very well, despite the odd jitter, as we've just mentioned. Again, one of the big themes at the moment seems to be a lot of wealth managers, fund managers talking about the risks within the AI sector, the so-called AI bubble, and also the level of concentration risks now there is in the S&P 500. It used to be the Mag 7, but basically those big tech stocks are dominating the S&P 500, creating an illusion that, hey, I'm diversified across 500 stocks, but you're not really. You're actually buying the S&P 500. You're very focused on a small number of stocks, all operating in the same sectors. Do you think as that index keeps going higher, we're seeing more of a concentration of risk in what didn't used to be such a risky trade?
Yeah, I mean, I think there's quite a lot to unpack there. I mean, firstly, it's been a very, very good year for equities. The S&P is up by, I think, about 15 or so percent as at the time of recording. I don't have the figure in front of me. And we've still got, 2.5 months of 2025 still to run. It has clearly been a very, very good year. The whole AI theme, is it a bubble? Is it not a bubble? There's always going to be these sort of labels thrown around. Anytime anything goes up, frankly, quite a lot in a short space of time, there will be people out there willing to call it a bubble. When you add on top the fact that this is all very, very new technology, that no one quite understands the potential of it just yet. I certainly don't. I don't think even the people that are building these models truly understand what they might end up doing. And throw on top of that the fact that things are, how do we put this nicely, starting to look rather circular within the industry. OpenAI buying chips from a company and then taking a stake in that company and sending an order to another company, all this kind of stuff. There is enough there to construct a narrative that it is a bubble. Do I think it is? I'm not going to make that call. What I do think is that the key things markets are focused on now are, firstly, we've moved through the initial sort of euphoria of, oh my word, ChatGPT, I've had to play around with that. That's amazing. Let's go and buy NVIDIA. To companies have spent a hell of a lot of money on this. Capital expenditures have gone through the roof. Are they being monetized? You look at companies like Meta, you look at Microsoft, all of these hyperscalers, as they would be called. They have spent a hell of a lot of cash. What is the return on that? And we're 3 years on now from the launch of ChatGPT. And I think that's the thing that markets are starting to focus on is, you've spent all this money. Are you getting a return on it right now? 2, when will you get a return on it? The second thing in terms of the AI space is actually we've sort of moved on, in my mind, to the second derivative of AI in terms of a thematic view. When this came out, everyone's going, semiconductors, chips, that's what we want. Who makes the chips? NVIDIA, AMD, all of these companies, and also you can throw in TSMC and ASML into that mix as well. The focus now is actually people are starting to wake up and go, there's more to this than just a few GPUs and a few computer chips. We've also got huge data centers that need to be cooled, that need to talk to each other. They need networking equipment, that need power and electricity, which is going to be a big issue here in the UK, given where energy prices are. And now you're starting to see that theme actually broaden out away from just the tech sector. And that's actually something that I've been sort of loath to use over a number of years now. Is it feels a bit lazy to just say the market is all technology. And certainly the Magnificent Seven, you drill into the Mag 7. Well, yeah, Amazon is a tech company. They've got a huge AWS division, as we all found out yesterday when the servers went down. But they're also an e-commerce platform. Everyone is buying things on Amazon 2 or 3 times a month. Tesla, they're an auto company. Meta, they're an advertising platform. And so are Alphabet or Google, ultimately. So even these sort of quote-unquote tech businesses are actually quite diversified and more diversified than you would expect. And the same goes for returns in the S&P 500 this year. If you drill into a constituent level in terms of the individual index members, the best performing Magnificent Seven stock this year is Nvidia, which is up by about 35%. But that's not even in the top 50 best performers in the S&P 500. So actually, the rally has been surprisingly broad, despite all of this, shouting and screaming from the sidelines that the top is in and it's a bubble and it's all going to collapse tomorrow.
That's a very refreshing view. It's good to hear someone taking the other side of that argument, because I keep hearing about, oh my goodness, if you looked at the valuations on some of these top tech stocks, they'll never justify that in terms of their revenue. Although, having said that, even TSMC, another great set of results from them recently. So, I could see this continuing.
Yeah, and this is the thing, even though the market has such a high bar in terms of its expectations for these stocks, and obviously we move into the bulk of reporting season in the States next week, these companies by and large continue to keep meeting this bar. And as long as they're meeting the bar or even raising that bar, there's very little reason to be betting against them, I think.
And last thing I wanted to talk to you about was UK stocks. Obviously, we have
Oh,
a lot
no.
of UK listeners.
Oh, no. Here we go.
Depends on who you speak to. Some people say they're really cheap. This is a buying opportunity for a generation. But I had a conversation yesterday with a fund manager who said, no, they're looking expensive to me. And on top of that, we have obviously the budget looming in November. A lot of companies with hiring freezes in. A lot of concerns about what might be in that budget. What's your take on the UK equity markets and indeed on the overall sterling assets right now?
Yeah, I mean, we'll get onto the budget momentarily. I think in terms of UK assets, I think it's very important to make a distinction between the FTSE 100 and everything else. Whenever you're looking at the news or reading the FT or whatever, everyone goes, FTSE 100, that's the UK market. Well, it is the UK market because it's stocks traded on the London Stock Exchange, but that's about the extent of its connection to the UK economy. I think about 80% of revenue and sales generated by FTSE 100 constituents are actually generated from outside the UK. So it's not a particularly good bellwether of how the UK economy is performing. Yes, the index is up 20% this year on a total return basis. I'd say probably none of that has anything to do with how the UK is performing. I mean, if you look at the FTSE 250, which is the mid-cap index, we're basically flat, which is probably a more representative performance. Now, yeah, UK equities are cheap. They've been cheap for a hell of a long time. We're trading at a PE ratio of sort of 12, 14 compared to about 25 for the S&P 500. But there's probably a reason why those equities are so cheap. And there are, I would say, two primary reasons for that. The first is what I would put down to being ultimately structural issues with the London market that have been discussed at some length. The liquidity is not particularly deep. Trading volumes are not particularly high. And there's no new listings. This year the London IPO market is outside of the top 20 capital raising venues in the world. And I've got nothing against the people of Mexico or Oman, but frankly, it's shameful that London has raised less capital than those countries this year. The second issue, when you set that aside, is the fact that the economy has just been paralyzed by uncertainty and has been battling stiff growth headwinds for a year now. Of course, we had the budget last October where the bulk of those tax rises fell on businesses, which have been relentlessly shedding jobs ever since. We now are in pretty much the middle of this sort of pre-budget run-up period into the budget this year, which has resulted in an incredible level of uncertainty because nobody knows where the tax hikes to fill this 30, 35, 40 billion pound black hole, however big it is, nobody knows where those tax rises are going to fall. So as you alluded to, businesses are not hiring, consumers aren't spending, certainly not on big ticket items. And I think it's almost this sort of perfect storm where that lack of economic activity is naturally going to feed in to an underperformance of domestically focused companies. And that's before you consider stepping away from the equity market momentarily, whether the plans that the Chancellor Rachel Reeves announces at the end of November, whether they're actually going to be credible with market participants. Because if you have some, sort of creative accounting going on and all of the tax rises come at the back end of the forecast horizon and there's not really any sort of inclination shown to be cutting spending in any way, then I think that's going to land very, very badly with participants, certainly in the gilt market. So I think I would sort of separate the FTSE 100 from everything else when it comes to the UK. I think the FTSE can rally regardless, and actually sterling softening a bit would actually be a boost for the market because of all the overseas revenues it has. But I think for the pound and certainly for long end gilts, I see very, very little to like whatsoever, to be honest with you.
Do you, and just to finish really, because I realise we're running short of time, but do you think, if we're looking at the budget at the moment, I mean, the frenzy is just going to go up in the financial press between now and the end of November. I've been writing about financial markets for 30 years, and I can't remember this level of intense speculation, forensic analysis of UK budgets than certainly this year, last year, potentially since the infamous mini budget from Liz Truss. Do you think that that's what's caused it? The fact that the government almost crashed the gilts market, and now it's drawn a lot of attention to this kind of thing?
Partially, and I think part of this is of the Chancellor's own doing. I think undoubtedly any government of any allegiance is now going to be much more cautious because of that reaction that we had in 2022 to, well, I was going to call it the mini budget, but if that's what it was called at the time, but it wasn't mini whatsoever. I think the Chancellor has also made a couple of problems of her own making. The first is the timing of the budget. We all knew it was going to be autumn. She then announced it 12 weeks ahead of when the budget was going to be delivered in Parliament. She set the date in stone. And I think that was a mistake. Clearly, the strategy was, let's kind of hope for a miracle, hope something turns up to bail me out in that 12-week period. What's actually happened is you've just locked in 3 months of uncertainty. And as you said, speculation in the press, and the rumour mill has gone absolutely wild. And it's only going to get worse as we get closer and closer to budget day. The other mistake that I think the Treasury has made is elevating the Office for Budget Responsibility to this sort of godlike position whereby we are ultimately now at a point where this is government by spreadsheet. And what I mean by that is, after the October 2024 budget, Rachel Reeves lost effectively all credibility with financial markets. The spring statement, where spending cuts were promised but then not delivered, restored fiscal headroom not only to the level it was at in October, but that level to 2 decimal places, which tells me that they have been sat round a table in the Treasury going, how do we just make the numbers add up to where it was before? This is the problem that we now have, whereby it's all become a bit of a reflexive loop, because Rachel Reeves is basically making her decisions on what the OBR's model says. The their model is taking inputs from where financial markets are trading, and financial markets are listening to what the Chancellor's doing and reacting to that. The way you get around that is you need to rebuild your credibility with financial markets. And frankly, having spoken to a number of gilt market participants, unless there is an inclination and a significant desire shown to reduce government spending, they are not going to have any confidence in the Chancellor's stewardship of the economy. And frankly, we sort of run the risk of going through the budget this November, and then in 6 months' time, guess where we are? Another fiscal black hole. Which taxes are going to go up? Which spending lines are we going to cut? And you just sort of end up stuck in this kind of doom loop. So I know that's not a particularly cheerful message to be sending, but ultimately that is where we are, I think, unfortunately, at this moment in time.
Yeah, that doom loop phrase is one that does seem to get bandied around a lot at the moment, doesn't it? Thank you very much for your time today, Michael. Thanks.
No, my pleasure. It's been good to chat. Nice conversation.
And I'll get you on again, because it's been very entertaining as well.
Indeed. Looking forward to it. Thanks very much indeed.
The content of this podcast is for information and entertainment purposes only, and does not constitute financial advice. The views and opinions expressed by guests or hosts are their own, and do not necessarily reflect those of the Armchair Trader. Investments can go up and down in value, and you may not get back the amount you originally invested. Past performance is not a reliable indicator of future results. We do not provide any personal investment, tax, or legal advice. Always do your own research or seek independent professional advice before making any financial decisions. The Armchair Trader is a media company and is not authorized or regulated by the Financial Conduct Authority.